Adani Group of stocks have been in the eye of a storm after US-based short seller Hindenburg Group released a report. Now, the Adani Group of stocks have remained under focus since then. Now, the spotlight is also on mutual funds which have exposure to Adani Group stocks. Now, to decode this, we had a special interaction with ET Now and ET Now Swadesh's managing editor Nikunj Dalmia. Let's listen in. All right, Nikunj, welcome to the ET Money Show. And today we're going to talk about the mutual fund exposure that they have in Adani companies. And so far, the data that we have till December is that more than 20 mutual funds have approximately slightly more than 23,000 crores exposure in almost 9 companies. How would you like to break this down for a normal mutual fund investor who has a mutual fund scheme that has invested in one of these companies?
See, Kavita, the stock selection ultimately is a process, and every mutual fund follows a very different kind of criteria. Now, you look at the Adani Group of stocks, and the collateral damage and market cap is so high that everybody is worried about mutual funds which have exposure to Adani Group of stocks. But most of the mutual funds which have exposure to Adani Group of stocks is actually not in the original Adani companies. It's in Gujarat Ambuja and it is in ACC. These are 2 cement companies which were acquired by the Adani Group. So theoretically, they will qualify as Adani Group of stocks.
Right. But
technically, they are not the Adani Group of stocks which are the original Adani Group of stocks. So 3 more popular stocks which our research is showing up is Gujarat Ambuja ACC combined now, and then Adani Ports. These are the 2-3 stocks which in a sense have a common thread with mutual funds which are there.
Okay.
Then you got some other mutual funds which are small in size, but they have different style of stock picking, whether it is Quant or NJ, some schemes of Motilal Oswal. That's where I think you could ask the fund manager that what were the factors in play and what prompted you to buy into some of the original Adani stocks and what criteria were at play. So that is something which you really need to understand, that okay, why did you ignore concerns of a leverage?
Exactly,
why did you ignore concerns of the balance sheet? Was it pure momentum which you were betting on, and which in a sense was the factor that you got Adani stocks in your portfolio?
So is there technically anything to worry for a mutual fund investor? Because mutual fund as a product, Nikunj, is a very well diversified product on its own. Now, as compared to a particular stockholder or a shareholder of any of these companies, do you think there is any reason for mutual fund investor to worry?
So, Kavita, it's not that mutual funds have not gone wrong in identifying stocks. Now we are magnifying the Adani Group of names, but there are a lot of examples where the basic business calls have gone wrong. I remember there were mutual funds which had a very large exposure to ADA Group of names. There were mutual funds at some point in time after 2008 and 2014, they had exposure in some of the infra names which were part of the Nifty 50, but the cycle actually went wrong. There were a lot of mutual funds which had exposure in some of the telecom names, and then came the Reliance Jio moment. So getting a business cycle wrong is something which has to be an elimination process.
Right.
But to imagine that just because a mutual fund scheme has invested in Adani Group of stocks, does that really make it a black sheep? I think that would be too much of a scrutiny, and that would be slightly harsh.
Also, we have to keep in mind that they cannot have more than 10% exposure in any one specific company. So there the interest of an investor is already protected. But I also want to understand the arbitrage angle in this, because a lot of sources-based reports say that 80% of this exposure was in an arbitrage position form. What exactly is that?
So what is arbitrage? You essentially are betting on a price differential. Normally arbitrage mutual funds are the ones, or arbitrage schemes are the ones which in a sense do these structured transactions, where if there is a arbitrage available between difference between the buyer and the seller, can they really capture it? I think the arbitrage must be at play because of the open offer which was at play between ACC Ambuja and what the Adani Group had initiated as an open offer. So maybe it was some of the arbitrage funds may have taken exposure in that. I'm not so sure about which schemes have arbitrage, which funds did play on that spread, but it really could be an arbitrage between the cash and the FNO also. But by and large, I think the arbitrage would be at play largely because of Adani's acquiring Ambuja and ACC, and that gave arbitrage funds a real play because the open offer process was on a couple of quarters ago.
So, Nikunj, you meet a lot of fund managers, a lot of AMC's head. So now when you're meeting them, you're talking to them, what is the sense you're getting? What is going to be their strategy? How are they trying to beat this volatility and try to protect the investors?
Kavita, let's say 10 years ago, if a real big group and Adani Group was the second largest, biggest group of India. If a group of that size and caliber 10 years ago would have seen a 50% collapse in the stock price, then the market would have fallen 25 to 30%. But Nifty, despite what has been thrown at it, is actually flat in this year. It's been a very volatile year. It's been a year where news really has been coming on all the sides, and the Adani group of stocks have been very volatile. But despite that, Indian markets are holding on. The limited point I'm trying to make here is that Indian markets have become far bigger than an individual company. And even though in individual stocks you may see volatility, in one of the largest corporate group, the markets were choppy. There were some nervous moments, but that has not really broken the back of the market. Unlike previous instances in the previous decade where we've seen collateral damage which has happened to large corporate groups, that has had a very large cascading impact on the market per se. Thankfully, that is not happening. So for me, that is an indication of maturity and how the Indian economy in a sense has really expanded and become big.
So last question to you, and then we'll wind up this discussion. What is going to be your Nivesh Sutra out of this entire fiasco or whatever is going on in the market? What is that one tip that you would like to give to our viewers?
The biggest tip I would always give everyone is that do not cancel your SIPs. So that is the real biggest tip, so to speak. And you got to ask yourself a very basic question: that will tomorrow be better than today? If tomorrow for the economy is going to be better than today, then you need to bet on the tomorrow and don't worry about today. When we are reacting to a daily news flow, we are worrying about today, but what we should focus on tomorrow. We should always focus on not where the puck has moved, but where the puck will move. And the puck for Indian economy, I think, is headed higher. You look at the positioning of Indian economy, I think we are in an enviable spot.
Right. Very
the economy is growing. Now, we will head towards 5 trillion. Now, it's a matter of 3, 4 or 5 years. Imagine when you reach there and when the world is contracting. I mean, look at our budget. It is talking about fiscal consolidation.
Right.
It is a growth-driven budget. It is a budget which has given something to everyone. Unlike Western economies where the balance sheets are inflated, the fiscal deficit is out of control, there is serious unemployment, they're dealing with energy and gas crisis. So if you have to really compare, and since in markets we do both relative and absolute comparison, on an absolute basis and a relative basis, we are in a much better space.
Right.
So आने वाला कल अगर आज से अच्छा होने वाला है, तो आज की चिंता क्यों करो?
Exactly. Now, that was supposed to be my last question, but because you mentioned the budget thing, I really want to ask you. So when you were interviewing the FM, she was really calm and composed, and the interview was flawless and so smooth. I want to understand her take on the normal taxpayer, that she says that, she's trying to, the middle class always wanted to have some money in their hand, okay, which to the new tax regime, they have done it. But what exactly is the intention? Do you feel that the old tax regime, because that's a very big question, it's everywhere. People are confused whether they should be sticking on to the old tax regime or should move on to the new tax regime. Wherever they feel it's beneficial and more savings, they should really opt for it. But do you think the old tax regime fading off? What's the intention of the government behind this move?
So Kavita, just like one shoe does not fit all, I don't think there's a standard advice. Right. Let's first talk about the intention, why the government is doing it. The intention is very clear that if you look at a tax regime which is full of exemptions, it's a complicated tax regime. It's a tax regime where you never be able to, you'll always have complicated structures. I think the government is trying to simplify that. That is the basic objective. When I specifically asked the Honorable Finance Minister that what is the real driving factor behind it? Is it because you think there are revenue leakages which would be stalled? He said, no, we want to move to a simpler tax regime. So in India, the tax structure, even at corporate level, is becoming very simpler. And even after GST, the tax structure, I think, is very easy to understand. So you have headed towards a simple tax regime. In order to make it attractive, if you want something new to happen, you have to make it attractive. So that explains that why incentives have been given to the new tax regime. So anything above 7 lakh, anything below 7 lakh rupees, it's not taxable. You want to make it more acceptable. The finance ministry is of the view that in next 2 years, they expect 50% of the taxpayer to move to the new tax regime. If you look at the large pool of Indian taxpayer, the Indian taxpayer pool is anywhere between 10 lakh to 15 lakhs. I'm talking about the pool here. I'm not talking about outliers. Within that, large part of the tax paying category is going to be happy with the new tax regime. But the minute you go to the higher bracket, obviously the exemptions will not work very favorable for you. Right. If you are in 50 lakh plus, if you're in 1 crore plus. So those exemptions are something which will not be giving you large benefits, which means it is obviously better for you to stick to the, move to the new tax regime. If you're in the lower regime, if you got a home loan, and if you know that you will be servicing that home loan, then obviously it makes sense for you to stick to the old tax regime. So depending on the category, what kind of exemptions do you have, I think it's important. But there's one thing which I've always said, and when I've been asked this question, that if you're doing compulsive saving to save taxes, please continue to do those savings.
Okay.
You may not get the tax benefit, but if you're in a habit of saving, I think don't leave that habit.
One last question.
Yes, please.
So the new tax regime, there is a lot of reports that also I've been reading, and to a certain extent, even I personally think Indians as a mindset, you know, wherever we get a tax relief or anything of that sort of, we are automatically, naturally inclined towards opting that. Now the new tax regime forces us to do investments and right kind of investments, especially when we talk about investing in insurance, you know, which we hope the new tax regime just takes away this habit. Traditionally, do you think Indians will now have a mindset towards investments rather than having tax-saving investments?
So, Kavita, we must understand and appreciate the nature of the economy is changing. What India was, let's say, 15 years ago versus what India is and where India will be, the shape of the economy is changing. Services is becoming big. You know, in school, I remember when I did my economics class, India was an agrarian economy. Now, it's after 30 years, India has become a service economy. Within service also, the nature is actually changing. In a country like India, when growth is high, and when you know that next 5 to 7 years are going to be high, is going to be a high growth period for you, imagine the kind of economic boom which would be unleashed. And when an economic boom is going to be unleashing in front of us, the best way is to really participate in that. In India, the interest rates are high and inflation is also very high.
Right.
So if you are young and if you really want to capitalize on the India booming story or the real India story of this decade, then the best way is to buy equities for a longer term basis. If you are parking your money in fixed deposits, yes, you will get a short. Right now rates are high, between 7.5 to about 9, depending on the scheme and the category you fall in. But then you're also missing an opportunity of lifetime.
Right.
If you're young, you really want to participate, you want to build in that kind of you want to be partners with the corporates, you want to be partners with the great businessmen, because when you are investing in equity, not only you're taking a bet on India, you also taking a bet on the corporate and the entire culture which is getting created in India.
Right. All right, I have a lot of questions.
No, please ask me.
But then we are short on time. Thank you so much for being on the show, and then we are going to have you again, and we'll talk more on every aspect of investments.
Yes.
Thank you so much for joining today.